Okay, all right. And so today we're going to start. We'll kick off here with risk management and why it matters, right? Risk management. So risk management is a key and a critical component of what we do here, right? Risk management is essentially everything. As a matter of fact, when we come into trading, when it comes to trading and when you start up your day, if you're about trading, for the day and whatnot, the goal is not to make money. I mean, making money is by default. It's automatic, right? It's gonna come. But the goal every morning, your mindset every morning is that how do I preserve my capital, right? Every morning, our goal is that we want to be able to preserve our capital. We want to preserve our money, preserve our money. Preservation of money is going to be our number one thing, right? All that we are doing here is how are we going to preserve as for the money, we're going to be making money by default, it's automatic. But we don't want to be giving too much. We don't want to be giving our money to the market, right? We want to be able to preserve our money. But how do we do that? We do that through risk management, right? Risk management is going to run through different sessions and different days. As a matter of fact, I have a last session on risk management where I teach two strategies, right? And that two strategies, we'll get we'll come to that proper. But this is just a teaser. I teach that risk management. One of the strategies is that if you have to lose your money, that means you would have traded or executed a trade about 100 times, to lose your entire money, right? To lose your time money, that means 100 trades, back to back. And then I have another one that is, you should have traded 400 times if you're using that risk management strategy that I teach here. So the goal here, right? I'm going to be rehashing on this. I'm going to re-echo on this few times. The goal here is that we want to be able to preserve our capital, our trading capital as much as possible. Risk management is a foundation for of consistent profitability, right? If you want to stay in this game for a long haul, right? If you want to stay in this game for a long haul, risk management is going to be a critical part, a critical piece of what we do, who we are, and our trading journey. The goal of trading isn't just to win trade, but it's to survive and grow over time. A lot of times, and I've heard this, and it is it's something that I've seen myself as well, right? If you come into this market with just emotions and without a trading strategy and decision, etc., you're just going to blow up your account. You're going to lose all your money and you're going to be out, and you'll fold up quick. And you say that, oh, trading is not good, it's not for me, it's not, it's because you didn't have any proper risk management framework in place, right? And this is why people lose their money and then they are out, right? But we want to stay in for a long haul. We want to be preserve our money. We want to be very disciplined traders, right? That is a key word here. We want to be disciplined, traders. And how do we do that? It's going to come from our risk management approach to our trade, right? Trading without risk management is like driving without brakes, right? Trading without risk management, I put out here, is like driving without brakes. I'm not the one that's going to tell you what your engine is going to look like. If you're driving, you get into a car, you start driving 80 miles an hour, 100 miles an hour, 120 miles an hour, full speed, and you're just driving, keep going, keep going, keep going. And your car, you do not have brakes in there. We all know the end, right? We all know what's going to happen to you, right? I'm not the one, without being prophetic, without even closing my eyes, I can tell you your end, right? Without brakes and you're driving 120, 150 miles per hour, that is not going to end well, right? So trading without risk management is like driving without brakes, guys. No matter how fast or how skilled you are, it will eventually lead to a crash. I've seen this personally. I've lived this personally. Yesterday, I started sharing some of the things that have happened to me, in the market. And it is not a hearsay. Some of the things that I'm going to be talking about to you guys, it's not a hearsay. It's something that I have personally lived it. And so when I share something that, hey, guys, I want you to do this, I really mean it. And yesterday I made a statement here that it is always said that the first mouse gets the trap, right? The first mouse, when you put out a trap to to catch a mouse, the first mouse gets the trap. The second, the third, and all the other mouse that will come after the first mouse, they all get a cheat. They all get to enjoy. If you're gonna come, you're gonna be the second, the third, the fourth, and you will still get into the trap, that means you're not wise. That means all the mistakes that I have gone through, all the things that I've been through and I'm sharing over here, you didn't learn from that. You just went out and then you started doing things without a plan. And that should not be the portion of any student here, right? Because we have committed mistakes. This journey started 2017 for me, 2018, 2019. Lost money in the market. Learn it the right way. Because when I was doing it, back then, I have no prior education. It was just signals here and there, indecisions and emotions, and then just like that, my emotions were playing out without a strategy, and I don't want any one of you to do that. So trading without risk management is like what? Driving without brakes. We're not going to jump out here and start going to the chat and start doing it. No, I need you guys to understand this. I need you guys to internalize this. I need this message to go into your DNA, your genes, before we start even executing trade and we start going to the chat. The chat will go into there. That's the goal here, right? You cannot, start, taking trades without chart analysis and, putting the trade and all that. But without this, we're not even gonna go started. We're not even getting started. I want this to get into your bloodstream, get into your DNA everywhere. That when you sit down every morning, you want to trade. The goal is to preserve your capital. Our first and only goal here, right? Like I put it out here on this slide, is what? Preserve our capital, preserve our money. I don't know the kind of money you'll be bringing into the market, whether your capital to start trading is $100, $200, $5,000, to $20,000, $50,000. I've had students, I've had people. Everybody's goal and style, trading style and purpose is different. Their capital is also different. Their earning income is different. People come in with all sort of money, but our goal here is to make sure that we preserve our capital, right? All right, moving on. So when we want to preserve our capital, and then we want to be able to adhere to, good, best practices, and so that we stay in this game for long, then what are some of the things that we need to know and we need to adhere to? We need to, keep in mind. Number one is stop loss, right? We need to understand this. What is stop loss? A stop loss is a preset level where you choose to exit a trade automatically if the market moves against you, right? It protects your trading capital from major losses by limiting how much you are willing to risk on any trade. So whenever we are, be setting out a trade, we need to make sure that we know what a stop loss is. A stop loss is where it's a level, a preset level that we say that, hey, look, if the trade goes against me, the market condition, price action, etc., goes against me, this is how much I am willing to risk. And you set that line in there so that if the market goes south against you, it will take you out and then you are done so that you don't incur major losses, right? So if you go into a trade, as an example, you're going to say, hey, I only want to raise $20. I only want to raise $50. I only want to raise $100. And $100 is your stop loss. Your risk or your stop loss level is going to be that $100. Once the market or condition price action goes against you, when it gets into that $100, it should take you out from the trade, and that's you are done, so that you don't incur more losses, right? So stop loss is going to be critical. And why do we have to use stop loss? Number one, it prevents emotional decisions, right? Number one, it prevents what? Emotional decisions. When the market moves against you, emotions like fear and hope kick in, right? Look, this is going to happen. If you haven't pushed the button yet and you have not put in money yet, you might think, oh, it's okay. But once money is in place, your heartbeat, etc., all those things is going to come back with time. You'll overcome this, right? You become more disciplined, you become, a profitable trader, and so some of these things. But if you do not have a stop loss in place, you know, a lot of things, panic, hope, etc. But here, we don't you don't trade with hope. We don't trade with fear. We don't trade with this. No, we trade with our strategy and let our strategy play it out, right? A stop loss removes the emotions by automating your exit. So once you set a stop loss in, once it gets to that level, it takes you out from the trade, and then that's it. You are done, right? it prevents all those emotional biases and emotional, stuff, dramatic stuff, right? Number two, it controls your losses. No trader wins 100% of the time. Yes, if you have been to my demo session, if you attended a demo session before now, you will know we did a numbers game. And even if you are winning 30%, you are winning 40%. If you have attended a demo session, those of you who have not maybe attended a demo session before, maybe you have not seen the numbers game, my spreadsheet of numbers game. Even if you are winning 40%, it's still a big deal, and you can make a huge ton of money, right? You can make good money from the market, right? I know, some of you are positive confessing people. You can say you can win 70%. Yes, that is possible, 80%, 70%. But even on the conservative side of even 30, 40%, let me say 40%, it is still good money coming in. And if you have seen my numbers game, spreadsheet, you will understand why I'm saying this, right? So no trader wins 100% of the time. A stop loss ensures that one loss doesn't destroy your account. So the reason why we will ensure that we have stop loss, in there is that we don't want just one loss and then all the money in our account is wiped out, right? If you don't have a stop loss in there, once the market start going against you, guess what's going to happen? It's going to take you out, and it's going to go into negative, and then all your your trading capital, right? All your trading capital is going to be gone. It can be gone within seconds, guys. Things can happen so fast, right? Things can happen so fast here on the market, right? The market is not your friend, right? The market is not your friend. The market is not your pastor. The market is not your prophet. The market is not your anything. Your uncle, your auntie, your sister, your brother. Market is nothing. It's not your mother, your father, right? So we don't say, oh, I'm good with this. I hope that things will change. I'm just going to hold on to it for the next 5 minutes. Things will turn around. No, there is nothing like that, right? The market is not your friend. So we only play by principles here. We only play by a strategy here. So we make sure that one loss will not take out or wipe out our entire trading capital and account, right? Guys, I'm going through this foundational stuff. This is essential so that when we start executing and taking trade, that's the time that we're going to be talking about this again. So take note of this. Number three is it enables consistency, right? Having a stop loss in there enables consistency. Risking the same amount per trade lets you survive long enough to profit from your winning trades, right? Risking the same amount. So as we go into the market, like I said, in other sessions of risk management that I'll be teaching, we'll go deep dive. We take a deep dive into some of the strategy, right? So the same thing. Every trade you risk the same thing. You're not going to let your emotions play out and say, oh, this one is going to be my lucky day. I'm going to become a millionaire overnight. This one, last night I had a dream, and, I was driving a Lamborghini and I was driving this car. So, God is really telling me something. Don't let any emotions and, some religious, fanatic stuff, let you play out something that is not part of your strategy, right? We're going to be risking the same amount per every trade. You're going to have your trade plan, right? At the end of the trading journey, everybody's going to design their trade plan, and that trade plan, you're going to have what tradable assets you're going to be doing, what risk amount, risk percentage, etc. If it's going to be amount, it's going to be percentage of your capital, whatever. You have all that in there, right? So risking the same amount, that ensures that there's consistency in your approach to things. One day you're not going to raise $5,000. The next day you are raising $200. Nah, that is not consistency, right? So to ensure that we are in this game for a long haul, we are in this journey for a long haul. We're going to make sure that we are raising the same amount, the same percentage of our capital all the time. And that enables consistency, right? All right. The fourth one here is that it gives you peace of mind. Guys, you don't have to stay at the screens all day, right? You are protected. When you set up a trade, for me, whether I'm in Ghana, whether I'm in Doha, whether I'm anywhere in the world, whether I'm here in the US, I can set up a trade, and I'm visiting some farms and in some bush or whatever. But I come back, I look at it, and then maybe my trade has played out for me. Or if the market went against me, I know how much I was supposed to lose, right? You set it before even you leave, like you it is out of your screens, right? You got to be able to just make sure that you settle your trade. You know how much you are risking, so that you're not surprised. Nothing takes you by surprise. Oh, but I didn't know I was going to lose $500. Oh, I didn't know I was going to lose $50. But I didn't know this trade I was going to lose, $100. No, So that gives you peace of mind. You're not going to go to bed rolling from left to right. This is not going to give you sleepless night. No, you already know ahead, right? Because that's what I'm going to teach you. You know ahead right from the start. How much your risk is for this, right? But when it comes to position sizing, we'll have a big topic. When it comes to position sizing, when you're taking up a position, whatever, you are sizing this. There's no theory. You are doing it yourself. You are calculating this yourself. So we're going to do position sizing. We're going to do all these things, right? You know exactly how much your risk is. You're not going to go to bed and you're going to have running stomach all night because something has happened. No, that's not going to be something that we would do here. All right. So stop loss. That is what it is. We're going to make sure that we have stop loss in there in every trade. All right. Now moving on. Every trade that we set must be set. Set here is SET before we enter it, right? So once we are setting up a trade, once we go into a trade, I'm going to ask you that where is your set? Where is your SET? And by SET, what does that mean? To trade with confidence, with clarity and consistency, you must make sure that every trade is what set is SET before clicking the button to buy or to sell. So whether we're going long on the market, right? We're going long, we're buying, or whether we are shorting the market. I told you yesterday that the market moves in three ways, right? For a traditional investor is someone who buys shares and then hope that the share price of that stock will appreciate in value, and then they make money, right? And that can take forever, right? And there's nothing wrong. That's what I told you. I have a lot of shares, right? I have Tesla shares, I have McDonald's, Walmart, etc. I have all these shares, but that was then. That was then, right? These days, I only trade, right? Because I can imagine just buying a share for $100 and then wait for 10 years, and now the share price is now $115, $110. It's okay. There's nothing wrong with it. But here, when we go into a trade, right, whether we shorten the market moves in three ways. Whether the market is going up or coming down or going sideways, whatever that happens over here, we're going to make sure that we have a set in place, right? We are not traditional investors buying a stock and only hoping that it goes up. When it comes down, then we are not happy. No, we're trading. We can short the market if the market is coming down, and we can also go up. Go long when the market is going up, or even sideways if you know what to do as well. Sideways majorly is around options. Options is always great. With sideways market if you know what you're doing, right? But set here means there's an acronym. The S here means every trade must have a stop loss. Every trade must also have the E, the entry price, and every trade must also have a target. That's your reward, right? Set here means what? Every trade that we put in, it must have what? A stop loss. There must be a stop loss. There must be where you say that no, if the trade goes south against me, I'm out. This is my stop loss. This is how much I'm willing to risk. $50 is what I'm willing to risk. And I have that in there. And the entry price, this is going to be my entry price, right? This is where I enter into the trade. You must always and at all time have an entry price where you get into the trade. And at every time as well, in every trade that we get into, we will have a target, right? Our target is our what? Reward, right? It's always risk and reward. I'm coming to that. So with every trade that we put in, guys, every trade that we put in, we're going to make sure that we have what? A stop loss, our entry, and our target set. So every trade must be what? Must be set. That is what the acronym here means, right? Giving you guys a very nice, very beautiful acronym. Set. So if you put in a trade, you're not going to come back and say, Nana, this happens to me. I've lost this. I'm like, where you were part of this trade from the beginning, and we talk about set. You are going to a trade, you have the entry price, you have your exit price. Exit price is your stop loss, and you should have your target as well. You're not just going to leave your trade, or you not leave the trade and say, I'm just going to make money all the way to whatever. No, you should have your target in mind as well. right? It could be a 1-to-1, 2-to-1, 3-to-1 reward, whatever. We'll talk about that, in depth, very soon in another session, right? So every trade, guys, must be set, right? Every trade must be set. Let me see in the comment section, guys. Yes, 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 to know that you are with me so far, right? Let me see in the comment section, guys. Let me see in the comment section that you are with me so far. Let me see a yes from everyone right now. I want to see a yes. Guys, let's rock and roll. Let's rock and roll, guys. Let me see a yes. So far, you are with me. I didn't put you to sleep already, right? We are just only about how many minutes into our time, and you're already sleeping. Come on, guys. Go ahead and put in a yes for me. Let me know you are here, right? I'm not talking to myself, all right? Okay, all right. Let's keep going. And every trade as well. So we talk about, the stop loss, right? We talk about how much you are willing to lose if trade goes against you. A stop loss is a non-negotiable part of your risk management, right? A stop loss. You're not going to put it in and you try to negotiate over here. No, the stop loss is your non-negotiable part, is a non-negotiable part of your risk management. It is a maximum amount you are willing to risk on a single trade. So in every single trade, that is a maximum. That's your stop loss. That's your maximum amount you are willing to risk on every single trade. You are basically defining your risk right at the beginning, right? You go into a trade. A lot of times, what people are scared. Other people lose money. They blow up their account. They say, "No, trading is not for me." Trade is profitable. People have made fortunes. People are going to make fortunes. I'm still in here, right? I make money every day. If you're part of our WhatsApp group, and guys, I'm going to advise that you guys be part of the WhatsApp group. I don't know how many of you are already part of the WhatsApp group. So I have WhatsApp group and the Telegram group. I keep sharing some of these things, right? I share trades, trades that I've taken, money that we're making from gold last week, last 2 weeks, big money, right? Making big money from gold trade, the whole of last week, and even currency pairs as well. The whole of last week, okay, I was sharing them. We share all the time. When you have a grade, right? I'll talk about the grade, sometime later if I have the time today, right? But you need to be able to define your risk, right? Define your risk. This is what will give me peace of mind. I go into a trade, I know I'm only risking $300. I go into a trade, I know I'm only risking $200, and that's my maximum risk. You're also going to go into a trade, your only risk here is $50, $20, $10, $40, whatever amount, right? You're going to go in with that kind of mindset. We'll define our risk, right? You're going to define your risk. You're going to have to define your risk. If you're not defining that, you're not doing that, you're not going to protect your account, right? So stop loss help protect your account from large unexpected losses. It keeps emotions in check by defining your exit before the market pressures you. The market can put a lot of pressure on you, right? And one of the things that we use in easing out, that pressure, taking off the burden, that the kind of, burdens of from our shoulders, is having a stop loss. Because I know before I entered the trade, I don't know how much I was going to risk. So I will not be surprised, if the trade doesn't go as planned, right? You know, I know how much I was going to risk ahead, right? So technical level below a support or maybe a resistance support, supply or demand, position account maybe 1%, 2%, I know if it's 1%, if it's 2%, 3%, whatever of your account, right? If I'm wrong, I accept the small loss and move on, right? And that's it. So we need to make sure that we have that, in mind. So we're taking the SET acronym, one by one, right? The SET acronym, the SET. All right, let's go to the E. That's the entry, right? The entry basically is what? The plan to begin, right? The entry is basically the plan to begin. So where and when will you enter the trade? That is our SET acronym, the E, right? Your entry should be based on a rule-based strategy, a technical setup, a chart pattern, a break or rate test. We'll come to all this technical analysis stuff, right? We will avoid chasing the market. I see all these, YouTube people, other people, they say signals, say buy what? No, we're not getting into any trade like that. They say buy this. We get into a trade because we have analyzed the market. We know there is demand here, there's supply here, price actions come to pick up, all this imbalance over here. There's an unfilled order sitting here, right? There's an order block over here. There's liquidity sitting right here. We're not just going to pick up signals and other things like people they put out there and say, go and buy this at this price, exit at this price. No, I need to understand, right? And so for us, You know, you guys are going to be professional traders. You understand this. You're not going to chase any market. Oh, the market is going up, it's going up. Can I be part of it? No. If you are not part from the beginning, you didn't do analysis from the beginning, you cannot be part of it. And guess what? There is always money in the market. There is always what? Money in the market. So if today the market is going and you know you're going to chase it and say, oh no, no, but I can be part of this. I want to catch in on something. No, you're not catching in on anything. No, no, but I want to be part of this. I see the market is going to rally, it's going to go all the way up. Look, if you didn't do analysis and you're not part of the beginning, and you know the price action didn't come to you, for us, our strategy, and then we'll be coming to that very soon in some of our sessions, right? Our strategy, the strategy that I teach is that we wait for price action to come to us. We don't chase things. That's not how we trade. We know that there is an unfilled order over here, so different price action will come up here and then pick up the unfilled orders. And we want to go with smart money, big institutions, right? We study the footprints of big institutions, right? You know, UBS Bank, all the big banks, Citibank. You know, we study their footprints, and there's a footprint for the big banks, the smart money, and that's what we do. We don't follow retail traders and people sitting by learning something. No, we follow the footprints of smart money, big banks. What they do is what we do, right? Because they have the money to move the market. And so retail traders, I don't have the money to be moving the market. So what the big banks do is what we do. So when they move, we move. When they take a step, we step, right? That's what we'll be learning in this journey. So avoid chasing the market. Avoid chasing the market. Set alert. I'll be teaching you guys how to set alert, how to wait for price to come to you. A lot of patience is needed here. I'm not going to teach you things that you're going to lose your money, right? You need patience. You got to have to exercise patience. You're just going to get up and say, oh, the price is moving. I see a green candle. And so yesterday we started going to the chart and seeing some of the candles. So now I can buy. I need to buy. I need to buy. No, you're not going to buy anything, right? Just because you see a green candle, you see a red candle, so you want to short the market. No, you're not shorting any market, right? You need to understand why you'll be shorting the market. You do let the analysis play out. You need to know that this is a supply zone, right? There's liquidity right there, right? You are not going to be liquidity, but you're going to play out when smart money moves, right? Very important. A good entry improves your risk to reward ratio, right? A good entry will always improve your risk to reward ratio. When you have a good place that you will enter into a trade and you wait for the price action to come to you, it's going to be good for your profitability, right? Because you're not buying at the market order. You're not buying when prices are high. No. You buy low, you wait for price to come to the low price so that it will go along with you, go up with you, and then you make big money, right? So examples are breakout of key levels, pull back into demand zones and retest of demand zones, candle confirmations. Even though I write it over here, but typically what I'm going to be teaching you guys, we don't trade with candles, we don't trade with news, we don't trade with anything like that, right? We trade with our tech analysis and things like that. We'll talk about them, right? I don't just enter a trade randomly. I wait for the right movement. You're going to tell yourself, have to be patient. You're not going to get into a trade and say, I want to enter a trade over here. I want to do this. No, because the price or the candle is down green. I want to buy. No, we are not doing anything like that. You got to be patient, guys. All right, let's go to the T. So the T basically is your reward, right? We will define our reward, right? We will define our reward, right from the beginning of the trade. I'm going to ask you, where is your set? Where is your stop loss? Where is your entry? And where is your target, right? The target is the reward. How much do you expect to make if the trade goes your way? If we are right, with the trade, how much are you expecting to make, right? How much are you expecting to make if you are right? Your target is your take profit level, where you plan to close the trade and secure your profit. Always aim for a positive reward to risk ratio, right? Always aim for a positive, reward to risk ratio. Ideally, 1 to 1, 3 to 1, or higher, right? Targets can be set using Fibonacci. And I'm going to be teaching you guys where there is supply, where there's this demand, that can be your target, etc. We'll get to that, how to determine all these things, right? We'll get to that. If you are risking 50 picks, 50 pips as example. Your target, is going to be, 100 pips. That is going to be your 2 to 1, right? Or maybe 150. That's going to be 3 to 1 reward to risk ratio, right? If you're risking $100, your target is going to be what? $200. That is 1 to 1, right? I only take trades that justify the risk with strong potential reward. So in this journey, we're not just going to be, taking trades just anyhow. I'm going to be teaching you guys about 8 or 9 odds enhancers, right? And we will score our trade before you put a trade. It's not just going to be, people say buy here, buy here. See this here trend line, what is thing? No, we don't do anything like that. Indicators, SMEs, SMAs. No, I don't do anything here like that. We're not going to be using indicators to trade. We're not going to be using trade volumes here to trade. That's not what we do here. No, we don't do anything here. Here, we do what the big banks do. I'm teaching you what the big banks, how the big banks, how they trade. That's how you will learn to trade. No indicators, nothing. I'm not going to teach you guys indicators and, Bollinger Bands and all those things that you see on YouTube and all that places. No, no, no. We are not doing it like that over here, right? We're not doing anything like that over here. Okay, all right. So you only take trades that justify the risk with what, a strong potential reward. All the enhancers I'm going to be teaching you guys, you need to score them, and you need to have a positive on all these enhancers. After that, you score your trade. If your trade is not you're not getting 8/10, that means that trade is not even good in the first place. We will do everything to put the odds in our favor. Even if it goes against us, we know that we did our work, right? We did the work. That's how, the kind of things I'm teaching over here, right? We'll score our trade. At the end of the day, you score it. I'm like, how much were you getting on the trade before placing it? So even if it goes against you, then you know that yes, you put in the work. You're not just taking emotionally, charged decisions and just anyhow, right? So very important. All right, so that's our set. Anytime we're going to put in a trade, we're going to make sure that we will ensure we have our set, which translate into what? Our stop loss is there, our entry price is there, and our target is also there. Everybody with me so far? Let me see a yes, yes for this. Let me know you guys are with me so far. Let me see a yes, 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 yes for this. Everyone is with me so far, all right? Here we learn like what the institutions do. We're not learning retail people, YouTube people. No, that's not what we do over here, all right? Okay, all right. Let's keep moving. So this is why the set, really matters. This is why the set really matters over here. So as I've gone through the set, for you guys, having the stop loss protects your capital. Make sure you're writing this down. Put the capital, your risk blowing your account. We're not going to blow your account if you're coming in with $100, $500, $200, whatever. You're not going to blow. I'm not going to watch you blow your account, and that is what I'm teaching you over here. You make sure that you have your set. Set here is going to do what? The S is going to protect your account. The E ensures what? Precision and discipline, right? You're not just going to chase price and be chasing FOMO, right? FOMO, I talked about yesterday. FOMO, fear of missing out. Oh, everybody's going to make money from this. Why I'm not also getting into a trade? No. You get in, your entry price is set according to your analysis, according to your score, according to the boosters I'm going to be showing you guys, almost 8 of them. You will analyze your trade with all these trade boosters, almost 8 of them. If it does not meet this, you're not taking it. If you're scoring your trade, if your score is not about 8/10, you're not taking it. 80/over 100, you're not taking it as well. I mean, because you're an adult, let me say this. Because you're an adult, you say, you have your right. Yes, you're going to have your right. It's like, getting into a swimming pool and then you don't know how to swim. And then you get in and say, oh, because I'm an adult, I can swim, I can swim. Yes, you can swim your way, but you die your way on your own terms, right? But here, I teach you things so that even if it goes against you, you know that, yes, there's a learning there's going to be a learning curve, in there, right? The E here will ensure that, we put a trade, there's what? Precision and discipline, right? You chase price and lose control. Without it, right? When you just enter into a trade anyhow, I'm going to tell you, I have done it. It didn't help me on this journey, and that is why I'm doing this, knowledge transfer to you, right? We're filling in the knowledge gap. Don't put the trade, just by picking up signal or anything without any analysis or any prior knowledge to why we're taking that zone, right? You chase price and then you lose control. That's it. but when we put in an E, it's going to ensure that there's precision and what there's discipline. All right, the T here, what does that do for us? It will make sure that provides clarity and goal. This is where we're going to. If the trade, our orders get filled and we pick up our orders, this is going to be our target: 1-1, 3-1, 4-1, 5-1. And this can happen. So that can even be 41 or so. If you guys, some of you, if you guys were on the WhatsApp group or something, there was a trade. Oh my God, there was a trade. I've forgotten the day. Just about 3 weeks ago or something like that. There was one trade like that. I've forgotten the exact trade. But I think I got out of it early, and it's by the next day morning it has gone almost about 31 to 1%. 31, yeah, yeah, 31, 41, something like that. And those of you who were in that WhatsApp group, the general WhatsApp group, may remember this. And I said, oh my God. So imagine, I think how much was I? I've forgotten the exact money that I was risking per that trade. But essentially, if I've head on to it, that was almost about $41,000 or something like that, by the next day. But I think I got out early because yes, I think it was, maybe was it gold or something? Because typically me, by my trade purpose and style, gold is typically like the London session, and London session typically start like 3 a.m. And so by 11 a.m., if you're on American time, Eastern time, I'm done for the day, right? I don't trade past that time, right? And by the next day, gold has rallied all the way up, and it was almost like 41-1 or something like that. So if I've head on to the trade by the next day morning, that's almost about $31,000 or something like that. Can you imagine? But when you put in a trade, we're going to have your target. You're going to have a target in there. Um, you're going to have a target in there that provides clarity, provides the goal that this is where I'm going to, right? When it gets to this point, I'm out, right? And again, I was not mad at myself. I'm not upset at myself that why didn't I hold on? Why didn't I stay in the trade? No, I know what there's going to be money again tomorrow, right? The market is always there. It has been there for years, several years, right? Centuries, right? you know. So I'm not going to mad at myself. Oh, if I've held on to this, yes, I think I shared it in the WhatsApp group, right? In our group, and I said that wow, if I held on to this, can you imagine that I took the trade here, you know, and then it went all the way to 40-1 or 39-1 or 41-1, something like that. So if I held on to it, I was like $41,000 already for me by the next day morning, right? But I let my goal play out because what that money, yeah, I'm going to be making it over and over and over and over again in this. This is a lifelong skill set, right? This is a lifelong skill set. It is not an overnight skill that is gone. It's going to disappear. This skill set that I know, what I know, is not going to disappear and vanish into thin air just overnight. No, it's a lifelong. Every day there's going to be money out on the market, right? So be patient. Don't chase things and don't say, "Hey, if I don't get in the trade today, I'm gonna die." No, you're not gonna die. You're still gonna be here. All right. So why the set matters so much is that you make sure it's going to protect our capital. It ensures precision and discipline, right? And then also provides clarity and goal that this is going to be our target. Okay. All right. Now let's talk about six trading outcomes, right? Let's talk about six trading outcomes. As you're going into trade, as you're gonna go into trade, in every trade you take, there are only six possible outcomes over here, right? For me, that's what I call it. You can learn from somewhere else that might tell you different thing, but for me, what I've seen over the years and what I've learned in this journey, there are about six possible outcomes, right? Master traders, understand this and design their strategies to maximize the gains while minimizing their risks. Especially avoiding the one the one outcome that destroys their trading account. So for me, there are about six trading outcomes over here. So the first one is what? Large profit, right? The first one over here is large profit. So you get the trade, sometimes you can get big money, big profit, from a trade. Large profit. This occurs when a trade moves strongly in your favor, right? When a trade moves strongly in your favor and you manage it correctly, right? We're going to be doing that. We're going to be talking about, trade management and trailing your profit and trailing your trade as the trade goes in your favor, how to manage it, so that, you'll be, locking in some profit, even as the trade moves in your favor. but there's a way to do it so that it doesn't take you out, soon, out of the trade, right? So, if the trade goes in your favor and you manage it correctly, it can be large profit for you. So you let your winners run. I always tell people, Charlie, don't get out of the trade too quick, too early like that, right? That's how you don't get 3-1, 4-1, 5-1 reward, right? Let your winning trades play out. Don't be quick enough early to be out of the trade, right? You trail your stop loss to lock in gains as the price moves, right? That's what I mentioned. So I'll teach you guys how to move your stop loss even as the trade goes in your favor, and how to be locking in some profit, right? Sometimes, driven by news, technical, confirmations and momentum, etc. We're going to be learning how to bask in on this and how to, manage large profit, right? Example, if you risk 100 and end up making $500 or more, right? That is large profit, right? If you're taking a trade, executing a trade, get into a trade, and your risk this was only $100, and then at the end of the day you come out, you make $500 from that. That's a large profit, right? That is almost, 5-1, right? That's 5-1. That's a large profit. So let your strong trades breathe and compound your edge, right? Let it, let your winners, run. Let your winning trade run, right? So that's number one. When you get a trade, there can be large profit, all right? Number two is small profit. Sometimes you get to a trade, there can be small profit. Hey, every profit is a profit, right? Even small profit is a profit. This is when you hit your pre-set take profit level based on your, your risk reward ratio. So if you set your trade that, hey, you are going to make, 2-1, 3-1, and it hit that, target for you, your 2-1 or 3-1, that is good, right? That's small profit. And sometimes too, it can go even beyond where your target is. You estimated that you're going to do maybe 2-1, 3-1, but market condition, price action, other things, maybe it's been moving in your favor more. So what do? You can even move your target also a little bit up, right? So that it doesn't take you out of the trade, and you just get only 2-1 or 3-1 reward, right? You might exit early due to market uncertainty or your plan, right? These are your consistent base hit trade. So for example, if you're risking $100 and then you make $200 out of that, that is 2-1 profit, right? 2-1 profit. If you and that is considerably like maybe small profit, for me, right? Sticking to your plan builds consistency and confidence. If you're going to stick to it and say, hey, for me, every trade I'm going in, I'm targeting 2-1, 3-1, whatever, it's good. That's going to be consistency for you. And you're going to have your target in there all the time. But if market condition, for example, sometimes, if Trump is speaking or whatever, the trade is in your favor, let it run. That is money for you, right? That's money for you. I'll teach you guys all, some of these, strategies as well. All right. And then we have something called break-even trade, right? Break-even trade. Break-even trade. With break-even trade, this happens when the trade initially moves in your favor, but you move, your stop loss to your entry point to get stopped out, right? So sometimes, when a trade, your order get executed, right? You put in a trade, an order, and the order gets filled, right? The order gets filled. That means you are in a trade, and then you move your trade, you move your stop loss too quick to that breaking point. To move it to break-even point means that you move your stop loss right on the edge of the what do you call it, your entry price, and that is break-even. You're not making loss, you're also not making profit. And so if price was to come back again and hit that entry price, because your stop loss is moved on that on that entry price, now it becomes break-even. You didn't make money, but you also didn't make any loss, right? So it's even, right? This is even. This happens when the trade decision moves in your favor, but you move your stop loss to that entry point and get stopped out. I'll teach you guys. We go to the chat. We do all these things practically, right? We'll do all these things practically, take trades, etc. You guys will get to understand all these things. You protect your capital, no loss, no gain, but a smart defensive play. There is always, a way to do this. But we want to make money, so we're not going to be looking for break even. That is not going to be our trading goal, that we always want to break even. No, it's not break even here, right? We want to make money, right? So we're going to let our trade, run. But I owe you guys a duty to teach you guys this, right? But our trading purpose and goal is to make money from the market. And so we're not just going to go to the market and every day we are expecting to break even. I mean, then what is the purpose? Why are we here then? Right? So you enter a trade at $100, and then you move your stop loss, your SL, right? Your stop loss to $100, where you enter the trade, and the price hit 103 and then get stopped out. Uh, that means nothing. You didn't get anything, right? So sometimes some of the trade outcome, it could be break even. There are times when the market, there's so many things going on. There are news coming out. There are Fed reports coming out, and I'm teaching you guys all these things. There are Fed reports coming out, etc. So things like that, you want to be aggressive on days like that when Trump is speaking at a different time and Fed chairman Jerome Powell is also speaking. There were different announcements, CPI news and different things like that. Non-farm payroll, all those type of news. These are high impact news, right? These are high impact economic news that can impact your trader. So you want to be aggressive with your profit, as much as possible. But even that, there's a way to go around some of this, and we'll get to that, right? We'll get to that. So break even, right? And then there are days that you can have a small loss, right? You can have a small loss. This is the most common and acceptable loss in trading, right? It is the trade where you get stopped out, but it was planned risk. It's a trade that you get stopped out, but it was what? It was a planned risk. Why? Why? Because you set up your stop loss. Your stop loss does its work. It's working, right? So when the market condition goes against you and then it hits your stop loss, this is a small loss. And this is what a plan risk or a plan loss. Why? Because when you go into a trade, remember we had a SET in there, and we have our stop loss set in there. That this is how much we are willing to lose, right? I am willing to lose $50. I'm willing and ready to lose $20 for this trade. I'm willing and ready to lose $10 for this trade, right? I'm willing and ready to lose $500 for this trade, and it was a plan loss, a plan risk. So your stop loss is working for you, right? And that is what? A small loss, right? You lose about 1%, 2% of your capital, whatever that you put in the trade, that is what? A small loss because you already knew it, right? You knew way ahead that this was going to be, your stop loss. This was what was going to happen, right? Example is what? Risking $100 and your stop loss, you know, and then your stop loss is hit, right? Your stop loss is hit. Once the stop loss hit, that's it, right? Your stop loss is hit. Hit $100, you lose $100, and then you know that you plan to lose $100 if the market was to go wrong against you, right? The market was to go wrong against you, so you already knew ahead, right? You already knew ahead that if the market condition goes against you, I'm willing and ready to lose $100, $100 from the trade. All right, that's a small loss. And then we have large loss. Right, you can see from the gentleman with his hands, you know, over his head. Right, that means it's a big loss. Right, large loss. This is the most dangerous outcome, right? This happens when typically you don't use the stop loss that we're talking about, right? This happens, you know, when you don't use the stop loss. When you don't use the stop loss, when you don't use stop loss, you ignore your stops, hoping to trade. The trade will turn back around. You get into a trade without using stop loss, and then you are holding on to your mouse, and then you are hoping that the trade will overturn and then come in your favor. All these things, guys, I've lived it before. I've lived it before. I've lived some of this before. That's what I'm telling you. I'm sharing some of these things. You are hoping that it's going to be a quick U-turn, for your trade, and then all of a sudden, you are now positive, right? Sometimes you can even go down on your knees before your computer, and you are praying and begging that God, I will not do this again. There was one time that I said, God, oh my God, I will not do this again. Please, 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 let this market, turn around and then go the opposite way. So I'm positive, right? But the market does not respond to emotions. The market does not respond to sentiments. The market does not respond to all these things. Your theatrics, right? The market only moves by principles and price action and different things like that. What is happening? Economic news, right? So you're not going to get that and beg and beg God in front of your computer and say, God, please, this is my last time that I'll ever put in a trade, and I'll not have a stop loss, in place. Right, guys? I have lived this. I'm telling you, don't do it. Please don't do it. Okay? Don't do it. Don't do it. Right? There's a reason why I'm talking about this. So one large loss can wipe out weeks and months of your profit, your whole account, right? That is large loss, right? You raise $100, but your trade keeps going against you, and you lose $1,000 more, right? Never
Hey,
trade,
take a look.
never trade without a stop loss, right?
Hey,
Never trade
take a
without
look.
a stop loss. Don't do it. Never trade without a stop loss. Don't do it, guys. I'm begging you, right? I'm begging you. My knees are on the ground as I'm talking about this. Please don't do it. Okay? Please don't do it. Please don't do it. So that's a what? Large loss. And then there's a what? Catastrophic loss. That is the finality, right? You might never even come back to trading again, right? You might never you might never even want to hear about trading, right? When this happens to you, your thing is that, guys, I don't even want to hear about trading. Catastrophic loss, right? Catastrophic loss basically, essentially is, give me a second here. I'm getting all these beeps alert over here that I'll take a look at something. Looks like there's something coming into my trade. That's what happened, guys. You put in a trade and you set an alert. You set an alert, and I think in the market, oh, it's already 5. Okay, yeah. So the market is open. The Forex market is open, and I think there's something in there that's saying, "Hey, take a look. Hey, take a look." That means I see AUDJPY and other alerts. I'm getting on my phone, blasting just like that. Because catastrophic loss, guys. This is not just about big loss. This is an account ending. This is an account ending. This is going to be the end, for your trading journey, right? This is going to be the end for your trading journey. That is what catastrophic loss, guys. And this is not going to be our portion, right? Anyone here? And that means you didn't listen. If that's going to happen to you, that means you didn't pay attention. None of the things that we talk about here, you were not listening. You were not listening, right? You didn't pay attention. You were not listening, right? If this is going to happen to you, and that's going to be the end of the journey for you, because you've lost everything, right? That means you didn't have stop loss. All the things that I talk about, you were not listening. You were not paying attention, and that's not good, right? So trading without a stop loss, using excessive leverage. You want to be a millionaire overnight, so you bring all your savings in, saying, I'm going to flip this overnight, and it's going to happen without a stop loss, nothing. Letting a bad trade turn into a nightmare. Once you are out of the game, you can't trade again, right? When this happens to you, typically, and I've seen this. When this happens to you, it's going to be very hard for you to come back again, to the market, because you've lost everything. Why? Because basic things like stop loss, you didn't have it in your trade, right? You just thought that, oh no, I know what I'm doing. I know what you're doing. But like I said, you're an adult. You can say, I know you're right. You will swim on your own terms. You die on your own terms, right? Because there are protocols to swimming, right? There are protocols to what to things in life, right? An example is swimming. So you don't go out there and swim on your own terms, right? That's how you will die, right? Because there are protocols to what to swimming. All right. Okay. All right. Let's move on. Let's move on here. All right. Let's move on here. All right. Let's keep moving. Let's talk about fundamental analysis here. Let's talk about fundamental analysis here. All right. We don't trade with this, but I owe you guys a duty to know. So I'm teaching you everything that you need to know about this market, right? I owe you guys a duty, right? To know this. So let's go about fundamental analysis. So fundamental analysis is the process of evaluating a financial asset like the stock, currency, commodity, by examining related economic, financial and other qualitative and quantitative factors, right? The goal is to what? Determine the intrinsic value of an asset, which help investors decide whether it is undervalued or overvalued. right? So when you take a look at any company, there are things and different outlooks, different things that you can look at. So there are key economic indicators or key elements of fundamental analysis, right? And I've grouped them over here. So one of them is economic indicators. You look at GDP growth, unemployment rate, inflation, interest rate, etc. All these things are good to know and good to follow, but we don't essentially trade with this. We don't go get up in the morning to go look at what is the inflation for today before I trade. What is the interest rate? What is unemployment rate? We don't trade with that, right? But some of these news, they can impact the market. When some of these are coming out, they can impact the direction the market goes. But for traders, this is the good news about trading. We don't care which direction the market goes, whether the market is going up because of a news of unemployment rate or inflation, interest rate, whatever, or if the market is bleeding, right? It's bleeding red, coming down, falling. We don't care wherever the market the direction decides to go. Because for us, if the market is going up, it's good news going up, we can go along with it. If the market is bleeding red, right? The market is falling sharply, dropping like a stone. We can also short the market. If the market is going sideways, we can also make profit from that. So this is what makes trading, like good, right? We don't care about the direction the market goes, whether it's going up or coming down, sideways, whatever way we are in, we are game for it, right? We don't care, right? We don't care. I told you guys yesterday, when Trump 3 months ago, 4 months ago, whatever, I forget the exact date, when Trump announced their tariffs, right? The market was bleeding, rails coming down, and guess what? I was making money. I don't care which direction the market goes, right? When it goes up, comes down, goes wherever way. That's what we have been trained. Your eyes will be trained enough to see opportunities, right? That's what I'm going to be doing. I'm going to be training your eyes to see, right? This is a good place for a rate test. Let me join in as the market going down. This is a good place for a rate test, and then we're all going down, right? Go to train your eyes to see opportunity, to be able to detect opportunities. There's opportunity right there. Okay, so GDP growth, unemployment rate, inflation, and all these things, they are great, but we don't trade where it is. But they determine the direction of the market, and then we see, okay, all right, this is where the market wants to go. We as for traders, we don't care, right? Number two is industry health, right? Industry health. So trends, stability within the sector of the asset, it's okay. It's one of the key fundamental analysis, some of the key things, but we don't really care about that, right? Company financials, right? Company financials, for people that will be trading stocks, right? I'll teach you guys how to trade all these things, right? So for people that will be trading stocks, companies, revenues, earnings per share, profit margin, return on equity, debt levels, cash flows, etc. Balance sheets, all these things are great, but they are fundamental stuff. There are people who trade, with fundamental analysis, who buy stocks using all these things. But for us, there's a better way for us to even trade, right? And then news, event, and global development, right? News, event, and global development, news, event, and global development. With that, political changes, geopolitics, right? Geopolitics, Hamas, Israel, and all these people, they're fighting, they're throwing bombs at each other. There's bombs flying over their heads every night, right? All these political changes, central banks decisions, geopolitical tension between countries, every now and then. I don't watch CNN. Good for you if CNN is your only source of news, right? I'll be praying for you, right? I don't watch all this news. I don't care about all this, news out there, because the market is not driven by some of these news that are out there. I don't trade using the market news, geopolitical tensions, natural disasters. There's an earthquake here. There's that over here. No, I what I see on the chart is what I trade, right? And that's what I'm going to be training you guys. You guys will not trade with your uncle telling you, did you have this stock? Can you go and buy it? Go buy it. No, 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 no. When your uncle even tells you that, is your uncle, okay, all right, let me check out something. Then you see it, you look at it, and if it's good, then you buy it. What you see is what you trade. You don't trade with all these things that I'm talking about here. So sometimes, when I see some of these YouTube videos and they are talking about some of these things, as if it is the age is the only thing that is out there that people can look at and then trade with it. I laugh. I'm like, but this is not the right way, to trade, right? Fundamental analysis, stocks of companies, earnings per share, growth, and all that. No, we don't do anything like that. For us, we get up in the morning, you do analysis. What you see is what you trade, right? What you see is what you trade. So all these things are good. GDP growth, unemployment rate, inflation, interest rate, and all these center trends, the center trends and stability within the sector, etc. All these are good. Revenues, earnings per share, profit margins, return on equity, debt level, cash flows, etc. All these things are good, but essentially we don't trade with this, right? But there are key things that you guys can be looking at, reading, etc. Right? It's okay. There's nothing wrong with it. So why we don't trade with fundamental analysis, right? We learn them, but we don't trade with it, right? Number one is that it is useful for context, not precision, right? It is useful for context. If you're watching CNN, you're watching CNBC, I'll try and see if I can find a video. There's a guy called Jim Cramer, CNBC, and people love him, right? And he'll be pumping all these things, buy, go, go and buy, CNBC news, business news, CNBC. He say buy this, buy this. And I have an old video of him, and actually he was telling the truth, and he spelled out something. He said they deliberately do that, right? So that is why we will not be trading with the news. We don't trade with what we see in the newspaper, right? Right? It is useful for context, but not precision. Fundamental analysis gives us directional bias, right? Or market sentiment, but not exact trade entries and exit, right? You hear about this, you do this, for example, knowing that inflation is rising may suggest long position in certain commodities, right? But it doesn't tell us when to enter a trade. Knowing that inflation is going up, knowing that this is happening is good, but it doesn't tell you where there's going to be an entry price, exit price for what you're trying to trade, right? So it gives us that directional biases, but it does not really tell us exactly where to put our trades. So that's why we don't follow that, right? We analyze our chart and we go with it. Number two is what? Price always leads news. Price always leads news. By the time economic data, earnings are released, market often, have already been priced in the information. That means traders who solely, who absolutely 100% depend on fundamental analysis might be too late. By the time you come in and say that, you hear the news that price, this has gone up, look, the people that are going to pay for this, they've already gone. The market is already rallied up. You are too late to get into the game. So if you're going to depend on this and hear the news, it's already gone. It's going to be aftermath, right? It's only after when this has happened. When we hear the news, what does that mean? When you hear the news, that means something that has already occurred, right? Something that's already happened. So that's why I'm not going to be teaching you guys indicators. No, I don't even have a subject or topic called indicators, right? I can show you guys all these indicators out there. If you are SMA, SME 14, all these things in the Bollinger Bands and all these indicators, volume, etc. But I don't trade with indicators, right? I'll show you guys this indicator, but we're not going to trade with that. Because indicators, show you what has already happened in the past. Are we going to look at what is in the past or what is coming up, by our analysis? That's the same thing with the news, right? Breaking news. They tell you what has done what has happened in the past, right? It's too late, right? So number three, market reacts emotionally to news, right? Sometimes good news result in price drops, bad news result in price rallies. Why? Because traders often buy the rumor and sell the news, right? Market psychology can override economic logic in the long term. Number four is what? Fundamentals are long terms. If you're going to be trading this fundamental news and all these news that are out there, that means you're not looking for money today. You're not looking to be profitable the next day. Maybe you're looking for to be profitable maybe in 2 years time, 5 years time, 10 years time, right? Right? So fundamentals are for long term. Fundamental analysis is excellent for investing, not always for trading. Traders operate in short time frames and need immediate setups. right? I told you guys, for me, there are different things when I'm trading. If I'm trading, for example, gold or any other thing, as a matter of fact, even when I'm in the futures market, right, that I'm in all the time. If I'm trading futures market, by 11:30, I'm out, right? By 11 a.m., I'm out. I'm done for the day, right? I'm done for the day. That's where technical analysis becomes more practical, right? Because trading, we are not holding on to things like, traditional investor, right? We are looking for opportunities, right? It's going to happen, right? In the next 30 minutes, in the next 1 hour, in the next, 5 minutes, in the next something, 15 minutes, right? Time frame. We work with time frames when it comes to trading. So we are not trying to hold on to things, forever for 2 years. No, that is not us, right? Number five, it is not always black and white. It is not always what? Black and white. It is not always black and white. Interpreting economic data is often subjective. I told you guys about Jim Cramer, right? In that video on YouTube, very old video, he was saying that, yeah, they better, push some of these things, and that's why he's wealthy. He has a lot of money because they push this and pump this for people to get hype and then go and buy on CNBC, right? Right? It is not always black and white. Interpreting economic data is often subjective. One trader might see rising interest rate or as bullish for the currency, whilst another might see it bearish due to the slowing growth, whatever. All these news people, people writing article on Yahoo Finance, etc. That's their opinion. They are sharing their opinion. So one person might see it as blue, other person will see it as white, other person might interpret it as maybe good, economic growth. Other person will see that no, this is not a good economic growth. They are sharing their opinions. But in trading, we don't trade with people's opinion. What we see on the chart is what we trade. What the chart tells us, what the market tells us, right, in real time is what we trade with, right? This is why, I'm getting this into you guys, your DNA, right? What you see, you're not going to come to me and did you see this? Somebody share something. Somebody share something on Instagram or whatever. I'm like, this guy, someone like me. You go and see a news on Instagram, and then when somebody shares something, is the person saying the truth? So should I go and buy this or should I go and do this? I'm like, come on, man. Share something for me for Instagram. Me, I trade based off of something on Instagram. that is not possible. That's not going to be possible, right? I'm not going to trade based off of news on Instagram. No, right? You see something on Facebook, you chance on something on Facebook, like, this is it. Let me go and buy. Let me go and sell. Let me short the market. No, you're not going to short the market based off on that, on what you see out there, right? Again, it's people's opinion. They are sharing their opinion. We're not going to do that. We will not do that. We will not go along, buy or sell or go sideways or whatever based upon what people are sharing on TikTok, right? You know, take TikTok. I hope you guys know that on TikTok, the brain retention is only 5 seconds, right? I can't trade with news on TikTok. I can't trade with news on all these platforms, right? Something I will not do, right? And I don't expect that you guys will do because you guys are going to be professional traders, right? Learning the right way, like smart money, like Wall Street people, right? Smart money, all right? So as they are doing this, sharing their opinions, etc., this inconsistency makes it difficult to rely on fundamentals alone for trade execution, right? One person will say this, other person will say this, and then they're all sharing, different things, like that, right? This is why we are not going to be doing that, anything like that. So we talk about what makes the market moves, right? We talked about yesterday. We started talking about what makes the market move. The art of trading. We talk about why we went on the chart. It's driven by people, right? All the candlesticks that you see, the green, the red, and all those things. Yesterday we started talking about it, right? That is because people are buying. Some people are also selling, right? The candlesticks, right? Yesterday we started talking about it. That is a representation. When you take a look at the candlesticks, it's a representation of actions, price actions of individuals, right? The buys, the sells, and all of that, right? It's a representation of what? Of people, right? Of people. So when you take a look at this, GBP, AUD, and you take a look at all these, let me try and see if I can bring this up over here. Yesterday, if buyers are strong, it's more aggressive. You begin to see a green candle. If, let me bring this over here, try to change screens here for you guys. Trying to switch screens. Where is it? Okay. All right. Okay. Can you guys see the chat? I just switch. Yeah. Can you guys see the chat? Can you guys say, let me see a yes, because I don't know whether you guys are looking at what I'm looking at. Let me see a yes. Okay, all right. I see a yes. Okay, all right. So yesterday I tried talking about this, that you look, when you see some of these things, right? When you see some of these things, whether you see a red, green, whatever, it's a representation of what is happening on the market, right? It's a representation of whatever that is happening, right here. And the green, the red, and all those things, candles that you are seeing over here is what, um, it's the reaction of buyers and sellers, right? Reaction of buyers and sellers. At any given moment, if buyers are strong and aggressive than the sellers, or they've overpowered, the sellers, we're going to see an explosive, green candle. That means, buyers are in control of the market, right? Buyers are what? They are in control of the market. If you see explosive red candles, right? That means sellers are also what? They are in control of the market. That's what that means essentially, right? All these candlesticks that you guys see over here. Started talking about it yesterday. They are not here for fun. They are not here because we want to color. They are not here because we want to play. They are not here because we want to do certain things. But they are here just so we know that, oh, okay, all right, this is a representation of what actions that are going on. So trading is driven by people. Some who want to buy, some want to sell, and this constant interaction, right? This constant interaction between buyers and sellers is what creates all this price movement, all this red, green, and all these candlesticks, right? So when you take a look at it, you know when sellers are in control, and when it's green and all this explosive rally up, explosive green candles, then you know that, oh, okay, buyers are in control. That means there are more buyers than sellers, on the market, right? That is what that means. Now let's talk about order flows, right? Let me share a few things here on order flows, right? And you guys, let me know if you're able to see the slide, right? Let me see a yes, yes, yes. If you guys can see, let me see a yes in the comment or the chat to let me know that you guys can see the chat. Okay, all right. So let's talk about order flows, over here, demand and supply over here. See, order flow is the flow of buy and sell orders on the market. When you take a look at the chart, like I was sharing with you guys momentarily, not too long ago, all the green candles, etc. Um, Essentially, these are all demand and supply. There's demand here, there's supply here. The flow of buy and sell, orders on the market is driven by perceived value. People look at it and say, oh, all right, I see that there's value over here. I want to go high. There's something over here. Sometimes to fear, right? Sometimes to greed, sometimes to uncertainty. There are different market expectations, and that's what sort of result in what we see on the chart, right? So market order flow, whether going up, whether coming down, whether green candle, whether red candle, it's all driven by what? Perceived, value. It can be fear, it can be greed, it can be uncertainty, market expectations, etc. There are common market sentiments that drive what we see on the chart, right? There are common market sentiments that drive this, that drive whether it's a demand, whether there's a supply, whether there's a short in the market, whether buying, etc. Number one is optimism, right? So there's good news, right? Good news, bullish news, earnings beat, etc. can drive, the market up, right? sometimes to pessimism as well, right? Negative news, global crisis, etc. Your guess is as good as mine during COVID-19, right? The market will be red. Everywhere is red. It's just there's fear, there's panic. All these things can drive the market as well. And then fear of missing out, can drive it out. Fear of missing out, FOMO. Think that I'm gonna miss out. I'm gonna miss out on this. It cannot drive this. Terrorist attack. Your brother, or sister, auntie, uncle telling you, your husband, your boyfriend, girlfriend, whatever, telling you something. Hey, can you do this? All this can also make the market, react in a certain way. But even though it's going to be very minimal because it is the smart money, big banks and big institutional players that move the market. That when you see a candle like this, it's not somebody playing with $100, $200. When you see candles like this, it's smart money, 20 million, 50 million, 100 million, orders. That is what moving the market like that, right? Profit taking, people taking out profit, if you are trading stocks, etc. All these things can move the market, right, in different way. Trend continuation and reversal, patterns and expectations can all result in, can all drive, the order flows, whether a buy, sell on the market. Guys, I want you guys to pay attention. We're getting into things right now, right? Pay attention. Um, Now, charts, candlesticks, and order flow, right? I want to talk about charts, candlesticks, candles, and order flow. You know, um, so this is what happened. Like, typically when you take a look at the chart, right? Um, and what you guys will be doing after training, what you guys will start doing, you guys will start doing. So typically you, the trader, right? You, the trader, you decide to buy maybe 100 shares of maybe XYZ, maybe currency, right? Or contract if you're trading futures, right? Maybe the S&P, the Nasdaq, the Dow, or maybe corn, maybe soya bean, right? In the futures market, right? You're trading maybe crude oil, maybe gold, whatever, right? Certain units, certain number of units, shares, contract, whatever, right? Or stocks, right? At $50. So what happens is that typically, I'm just giving you guys the order flow, right? The order flow, how orders happen, how you as a person, as a trader, you will execute an order or you will buy, and this is the flow, the journey, right? That is what I'm trying to create over here, right, for you guys. So you, the retail trader, you as an individual, right? So you decide to buy something, maybe 100 shares of XYZ at $50. You send the order through where the trading platforms, right? The order is sent immediately to your broker, and everybody is going to use a broker, right? On this platform. And we'll talk about broker, we'll talk about brokerage firms, etc. Your broker receives the order. Your broker is going to receive the order and then routes it to an exchange, right? And then the order is now in the queue. The order gets queued when when the order gets received by the broker. Broker sends it. Some of the brokers in seconds. This has not happened in days or whatever. In the olden days is where some of these things. But technology has advanced so much today. This happens in split seconds or milliseconds. Let me put it that way, right? Milliseconds, right? Happening so quick. And then the order is queued at the exchange side. The order hits the exchange, number three, right? Once at the exchange, your order is either executed immediately, and when it's executed immediately, and that's going to be what? Market order, right? So it matched with the seller, it matched with the seller. Okay, you want this. You want to buy X unit of, maybe crude oil, right? You want to buy X number of contracts, for this. You want to buy maybe shares if you're trading stocks, right? You know, when it's executed immediately, that means it's market order. You buy it at a current price, right? If it placed in an order book, if the order gets placed in an order book, that means it's a limit order, waiting for a seller at your desired price, it's almost like a bait and ask, right? So in the market, you know, like you guys saw, you guys see on the chart, the red candles, the green, and buying, selling. It's people buying, it's trading. That's what's called trading, right? Buying, selling. So you wanted to buy maybe gold or silver or platinum. So for some of you will be trading platinum, gold, silver, or whatever, right? You want it at a certain price, and you place an order over there and waiting for price to come and get you. That means you will need somebody, or the market will fill your order when it matches with somebody also selling at that price, right? But all these things happen in split seconds. It doesn't take that long, right? So that's what limit order, waiting for a seller at your desired what price, at a desired price. That is what limit order. And then the order execution, your buy order is matched with somebody's sell order, trade occurs. That's what happens, right? So if your buy order, your sell order matches with somebody who also wants to sell whatever, and that is what results in what? A trade. That is what results in a trade. This action is recorded on the chart as a candlestick. So as you guys see the candlesticks over there, the red, the green, and all of that, that means a trade order has been fulfilled, right? A trade order has been fulfilled. So when you see a green candle, when you see a red candle, that means there is an order execution, happening. The trade order has been fulfilled, and so it matches, right? There's a bid and ask. There's a bid and asking, and that means there's a match over there, and that is what results in what we see on the chart, right? That is what results in what we see on the chart. So green candle is equal to more buyers, that's demand, price are rising up. Red candle, more sellers, supply, price falling, but there is a match in there. There's a fulfillment of an order, and that results in that candle. So more sellers, more buyers. That is what results over there. All right. So that is the order flow. So typically you see this, right? I have a picture over here, right? For those of you who get things with visual, right? So all that I talked on the previous page over here is this picture right here, right? Everything that I said over here, from retail trader placing the order all the way to the order execution, is what is seen over here in this pictorial or visual, right? So retail trader, order flow, right? Some of you wondering, so how am I going to, how is this going to happen? How am I going to, trade? When I trade, or when I say I'm trading and putting in an order, whatever, how does that happen? This is the journey, right? The user journey of that, of you, the retail trader, of the trader, right? You trying to short the market, go long, do whatever. So you, the retail trader, you are here. You are this lady, right? For just for today, for all the men, right? We are here, right? We are with this lady. We are all trading together, right? So our order gets sent, from our computer, from our laptop, from our phones, whatever. Our order gets sent. Say, hey, we've seen the Nasdaq, we've seen the Dow Jones, we've seen gold, we've seen this, right? We want to trade. We put in the order. The order gets sent to what? The broker, right? You guys can see, right? Let me see if I can get a pen. I can get a red pen over here, so I can mark it so you guys can see exactly what I'm talking about. Let me use red color over here. So this is a retailer, all right? So we move from here, right? And then we come over here, okay? And then the order gets sent from the broker, and right from the broker, it goes into the exchange, right? You guys can see what I'm doing. Can you guys see the annotation I'm doing on the slide? Let me see a yes to let me know you guys can see. Can you guys see the annotation, the red color that I'm using on the screen? To let me know you guys are following, right? Okay, all right. So it gets sent. The order gets sent from the broker. It gets sent to the exchange. It could be Nasdaq, the New York Stock Exchange, whatever exchange that for that tradable asset, right? And then from there, you know, it is matched. The limit order or market order, it is matched over here, right? Whether it's a limit order, whether it's going to be a market order, it get matched, and then it's executed. And the resultant effect of that is a candlestick that we'll see on the chart. This is very easy. I think this is the best explanation, I've given for anybody to understand this, right? So for my beginners, that's why I say, hey, you are the right place. This journey, whether you're a beginner, whether, this is your first time, whatever, yeah, I'm going to go deep down for everybody to understand, right? For every one of you to understand. It doesn't matter your background, where you're coming from, you understand this, right? I'll take my time, explain all this concept, everything, so that you get it, right? You become a professional trader. You can explain this to your children, and that's the goal. For me, all this we're talking about is just so we will transfer this knowledge to the people that will come after us, right? So they can also benefit, right? So when this is done, the resultant effect for whether a limit order, market order, for whatever you have done, is what we will see on the chart. So all our orders combined is what result in the green candle, the red candle, right? They are not magic. They didn't appear by magic, right? The green candles, the red candles, and whatnot. right? They're not appearing over here by magic. They are coming as a result of the orders that we've all, executed, we've placed, right? When we place the orders, that's a resultant effect, right? That the green candles and the red candles. Let me see a yes, yes, yes in the chat for me to know you guys are with me so far. Let me see that before I continue, right? Because we're going to be adding up. We're going to be building up, guys. We are building up. We're on our way now. We're getting into the meat and potatoes, right? We're getting to the heart of things right now. Okay, all right. All right, moving on. So that is the journey of the retail trader. When you execute a trade, this is the steps. This is a process that it actually goes through. You know, yeah, this is the steps. This is the process it goes through. So, the order flow, right? The order flow over here, the order flow over here, it gets sent. The order has been placed by the platform. It's on its way to the exchange. And then when it get executed, basically, this is a sum of everything that I've talked about, right? When it gets executed, the order is matched and is completed, and then it gets filled, same as executed. This is what shows up as candlesticks, right? When the order gets filled. When the order is unfilled, right? Not much yet. And these are pending limit orders, right? Potential turning points. So when the order is not filled, when the order is not filled and is waiting, then that means it has not been matched with an equal seller or buyer, who's ready to sell at a price, to sell to you at a price that you want or you desire, right? And typically in the future, these unfilled orders will become turning points for us. And this time, you guys may not understand what I mean, but you guys will get it when we get there, right? They'll become potential turning points on the chart, the direction that where things will go, right? When there's a big order sitting somewhere, for buy, somebody wants to buy maybe 50 million, 100 million, $100 million, $200 million or something, a unit or contract of something. As soon as price gets over there and there's a buy, if price was falling, price is going to reverse immediately because that's a huge order, right? That is what that means. It's a potential turning point. All those unfilled orders in the future becomes potential turning point. And you guys don't have to understand this well now, but you guys will get it as we move along. Okay, so this is the order flow state, guys. This is the order flow state. This is explicit enough for you guys. I've explained this. This is explicit enough, right? Explicit enough. All right. How are we doing with time? Okay, we still have more time. All right, let's keep going. Let's talk about candlesticks, right? Let's talk about candlesticks for a second, right? Make sure everybody get it. Everybody's gonna get this, right? We're not leaving anybody behind in this class. We're not leaving anybody, especially if you are showing up every day. We're not gonna leave you behind, right? I'm not leaving anybody behind, right? We all get it. We're all gonna be on the same page, right? We all move together. All right. So candlesticks, right? Let's talk about candlesticks for a moment. Let's talk about candlesticks for a second, right here. So every candlesticks, tells a story, right? All right. So when you look at the chart, as we were looking at, it tells a story, right? It tells a story. A strong green candle means aggressive buying, overwhelmed sellers, right? When you see green candles, guys, it means what? Buyers are in control of the market, right? Buyers are what? They are in control of the market, and they've overwhelmed or they've overpowered sellers, right? So that's why they are the chart is moving up in green, right? That means buyers are in control. A long wick on the top of a red candle may show sellers absorb all buying pressure and possibly a supply zone, right? A strong red candle into previous support followed by a bounce may indicate demands at that level. Guys, all this is English, right? We will come to the chat. We will learn about all these things, right? All these things is just English, right? All these things, is better seen, better heard, better understood, from the chat, right? You guys will get it. But essentially, every candlestick, right? Every candlesticks, you see that some of the candlesticks they have wick in there. Let me come to the chart for a second over here. You guys will see this on the candlesticks over here on the chart, right? There are wicks, long wicks. Some of them have long wicks, right? Can you guys see this for a second? Can you guys see the chart over here? Um, You know, some of this green candle. Can you guys see the wick? There's a wick on, you know, the candles, they have wicks, right? Let me see a yes in the chat box, right? Guys, this class is very interactive. It's not a door, it's not, you know, after thought you come back 2 days and I'll ask you. No, we are moving at the same pace in parallel, right? So can you guys see the wicks over here, right? The wicks. Some of them have long wicks, some of them have short wicks, etc. Right? You guys can see that. Pay attention, guys. I want you guys to pay attention. That's why I keep asking you guys to do something. I want you guys to pay attention, not be distracted. You know, you come back and you come and ask, silly questions, right? Because if you're getting distracted, come back and ask questions that I've already explained, right, over and over and over, right? I don't want anybody to do that, right? So there are wicks over here. You guys will see that short wicks, long wicks. They are all telling a story. They're all telling us something. Some of them, some of them over here. Let me zoom in over here. Some of them, you cannot even see a wick at the top, right? It's almost impossible to see a wick, right? They're all telling a story. Some of them with a wick at the bottom of it, they are telling a story. Some of them with a wick at the top of it. You see, some of them have a wick at the bottom. Some of them also with a wick at the top, and almost no wick at the bottom as well. They are all telling a story, right? They are all there for a reason. Whenever you see some of this, it's very practical, right? Very practical. Every candlestick that we see over here, it's for a reason, right? They are not there for fun. When you see something like this, almost without a body of the candle, right? This is what we call a doji candle, right? It's an indecision type of candle. They don't know where they want to go, right? But we'll get to that. We'll get going into the anatomy of the candlestick very soon, right? We're going to go deep dive into the candle. We're going to understand it, right? But some of these things, they are telling a story. They are telling us something that we should know, right? They're telling us something. Oh, we see a huge body like this, right? And then with a wick at the top, a wick on top of it. The body is at the bottom and a wick at the top. It's telling us a story, right? Maybe it's telling us that maybe it's showing signs of weakness. It's showing signs of weakness, over here, right? It's telling us something that we're supposed to know, right? The candlesticks are telling us something, right? So every candlestick, guys, is telling a story. Every candlestick is telling us something, a story, and we should not ignore the signs, right? We should not ignore them. We should not just think that, oh, they are just there. They are just there for nothing. Yeah, guys, give me 1 second. Give me 1 second. All right, let's continue. So all these candlesticks right here, they are telling us a story, right? Every candle tells a story. Every candle tells a story. All right, let's come back over here. Let's come back over here. Every candle tells a story. They are not there here just for fun, just for decoration. They are not here to decorate the chart. No, they are telling us of something that is happening. On the market, right? They are telling us of something, and so we need to pay attention. We got to pay attention. Okay. We got to pay attention. Um, when something like this happen or when we see something on the chat. All right, let's move on. Let me bring the slide over here. Let's move on. Okay, all right, all right, all right, all right, all righty. Okay, can you guys see the slide back again? Can you guys see the slide back? Let me see it. Yes, guys, very interactive class, right? I told you guys, it's a very interactive class. All right. Okay, all right. So, the candlesticks and all these things culminate into, unfilled orders, potential supply and demand zones, etc. We're going to identify strong reversal in the past, look for sharp moves. We're going to be looking at all these things. That's where the resistances, impulse, retracement, corrective phase, impulsive correction, all these areas, likely had, concentration of unfilled orders. We're going to take a look at all these things. We're going to be able to draw out our demand zones, supply zones. We're going to draw out all these things, right? We're going to wait for price to come to us. We're going to do all this analysis, right? We're going to do all this analysis. All right, now let's talk about the anatomy of the candlesticks. How many minutes do I have here? How many minutes do I have here? All right, let's keep going, guys. Let's talk about some few. I think some few minutes before I open up the questions. Like I said, this training, at the end of the training, the last 10 minutes of the session, I'm going to open up. I think I'm already in that 10 minutes, but let me talk about a few things here so that at least this will open up what we're going to be talking about, for next week Saturday morning. Okay, let me think about this here. Okay, let me do about maybe 5 minutes more, and I'll put it up for questions in the next after 5 minutes. All right. So the anatomy of the candlesticks, guys. Anatomy is, for those of you, my last batch, for instance, I had a pharmacist. I had about 2 or 3 pharmacists on my previous batch, and medical students. So when I talk about anatomy, they understand this better. Hopefully, I also have some few medical people over here or health professionals over here who also gets this, who also understand this, right? So anatomy is a branch of science concerned with the bodily structure of human beings, animals, and other living organisms, right? Especially as revealed by dissection and then the separation of the parts. When you pull things apart, right? When you put a human being, the skeletal system, you'll be able to put out and label out all the names, etc. Right? In the same way, we have the anatomy of the candlesticks. When you take a look at every candlesticks, like I said, it tells a story. It represents something. A candlesticks is a visual representation of price movement. A candlestick is a visual representation of what? A price movement over a specific period of time, right? So every candlestick that we see, it represents, a price movement over a specific period of time. It could be a day, it could be an hour, it could be, 5 minutes, 15 minutes, etc. It could be a week, etc. So when I come back over here on the chart, let me come back over here on the chart for a second. Um, all right. Can you guys see the chat? Please respond quickly because we don't have time. Can you guys see the chat? Quick, 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 guys. I want you guys to respond. Yes, yes, yes. All right. So all this candle over here, they have time frames, right? We have time frames for this. All these candles form within a certain time frame. So if you guys see over here, you guys can see I'm pointing to the left corner over here, right? I have time frames over here. And here I have daily. I've selected daily over here, right? So that means every candlestick that you see over here was formed within a certain period. Guys, we are getting deep dive into things right now, so pay attention, right? Every candlestick you see over here was formed in a day. It doesn't matter how big, small, large, whatever size that you see, it means it was formed within a day, right? If I come over here and I change the time frame to say 30 minutes, you guys will see that down the candlesticks have changed. The pattern of the candlesticks, they've changed. This is the same thing that we were looking at, but you guys will see that now there are more, right? There are more of the candles over here because 30 minutes means there are a lot of candles that's going to form. Let me repeat this slowly, right? Let me repeat this slow so that everybody will get this. When I change the time frame to 30 minutes, guess what? There's going to be more candle that will form in 30 minutes, right? Because there's going to be more 30 minutes over here. But when I say a day, there's going to be fewer. When I say a week, there's going to be even fewer. When I say a month, there's going to be even fewer, right? Because, if every candlesticks form within for the formation of the candlestick over here is for a month, that means that's a lot. A lot has gone into a whole month for us to see a green candle represented here, right? Can you guys see that? As a matter of fact, when I put the mouse pointer on it, right? When I put a mouse pointer on it, it tells us the month over here, like November 2021, over here, December 2021, over here, January 2022. So the whole of January 2022, this was what happened, for this. This is a month's representation of, different action by different buyers, sellers, but it resulted in what? In a red color like that, right? So every time frame is represented by something, right? When I change the time frame, we will see candlesticks, forming over here. It's going to be a lot of candlesticks. If I come to 1 minute, you guys, you bet, right? It's going to be a lot. There's a lot. If I go down to 15 seconds time frame, whatever, there's going to be even more candles forming, right? More candles, forming out here, right? If I go to 2 hour, 1 hour, there's going to be different candlesticks forming over here. All right, let's come back quick over here. Let's come back. Let's come back to business. Let's come back over here and keep moving. All right. Let's come back here. All right. Can you guys see that slide? Let me see a yes so I can continue quick. All right. Okay. All right. I see some response coming in. I believe that's what it is. Okay. All right. So candlesticks, they are a visual what? Representation. It's a visual representation of what? Price movement over a specific period of time. So 1 minute, 1 hour, 1 day, month, week, etc., etc. Right? You guys see it, right? Each candlestick shows where price open, right? Every candlestick. Now we get into the meat of things, right? When you look at the candlesticks, there's a place that we will say that this is where the candle open, and this is where it closed. This is the highest of the candle, and this is the lowest point during the time as well. I want you guys to pay attention to this, guys. I want you guys to pay attention. We're getting into things now, right? So every candlestick that we see on the chart, right? I'll bring out the chart very soon. We will be able to tell where it's open and where it closed, where it was the lowest of that candle and the highest of that candle. The same candle will have about 4 parts, right? Every candle, that we look at will have about 4 parts. The open price, the close price, the highest price, and the lowest price of that same candle. And you guys will have assignment very soon because I'm going to be giving you guys, assignment, right? So guys, pay attention. This training is not, it's not a fanfare. It's not ice cream. This training is not ice cream. You guys will begin to have assignment. You guys will have an email. You will be turning in your assignment, your work in. Uh-huh. So it's not a play. It's not a play here, right? It's going to be assignments coming in very soon. Right. So pay attention, right? So every candlesticks, that we see will have what? Where price open, where price close as well. The highest and the lowest point during that time as well. This helps traders see who is in control of the market, right? So when we look at things, we'll be able to know, oh, okay, all right, this is a bull's market, this is a bear's market. Sellers are in control, buyers are in control. Price movement within a time period, whether 1 minute, 1 hour, 1 day, whatever, it tells us, what is happening on the market, right? It tells us exactly what is happening on the market. So when you take a look at a green candle, right, guys, we get into things right now. When you take a look at a green candle, right, what it means is that buyers, bulls were stronger, like this candlestick over here on the side, right? It tells you that bulls were stronger. Price closed higher than it opened, right? Price what? Closed higher than it opened. And it's straight away. But let me indicate some few things over here. Can you guys see that? Because I want everybody to understand this, right? So, all right. So as you guys can see over here, you know, um, the green candle over here. I'm talking about this green candle over here, right? I'm circling this over here so that you guys can see what I'm talking about, right? It says what? Buyers or bulls were stronger. When I see a green candle like this, it means what? Buyers were stronger. But it also says something over here that I want you guys to look at. It says price what? Close higher than it opened. When you take a look at every candlestick, right? When you take a look at every candlestick over here, take a look at every candlestick. This is This is very clear, right? It says open. Can you guys see that? It says where it open and it says where it close. And over here, at the top over here of the wick, it's going to be the highs of it. And at the bottom over here, when you look at the down part of it, right? At the bottom of it, that is the lowest of it, right? So what this means is that, let me put an arrow over here, right? Let me put a quick arrow, draw a quick arrow over here. Hopefully my arrow, it looks good, all right? So price, that means this candlestick over here, over maybe, let's say it was an hour candle, 15 minutes candle, 30 minutes candle, it doesn't matter, regardless of the time frame, right? It means that it's open at a price of 50, all right? It opened at the price of 50. And then sellers try to push it all the way down, lows of, here, of 48, right? Of $48. And then buyers came into the action again and said, no, 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 we're not going to push, we're not trying to push this down. Let's push it all the way up. Buyers hold on to it. They push it all the way up here to 55. And then sellers step in again. So they said, no, 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 no. No, so let's step in again. And then finally, this candlestick, close up here, right? Let me say that one more time. The open price, this is typically, where the candle will open from. That's the open price. And then the lowest, sometimes, the market is always like a wrestle, right? I think that's the right way for me to use a wrestle, right? It's buyers and sellers wrestling, fighting, a banter going on, right? Somebody's trying to go up, somebody's also trying to push it down, right? And so they try to push it down to the low price of 48 down here, right? 48. And then buyers will step in again, right? Buyers say, no, 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 this is our market. We're trying to go up. And they try to push it all the way up. So they did their best to push it all the way. That's the highest of this candle was 55. And then sellers step in again, but they try to push it down, and then it finally closed over here at 55. So every candlestick that you looked at is going to have an open, it's going to have a close, it's going to have the highest, it's going to have, the lowest as well. Let me say that one more time for somebody, right? Every candlestick that we looked at, right, is going to have the open, the close, the high, and the low, right? So when we look at the structure of the candlestick, right, when we look at the structure of the candlestick, there's an open, the bottom of the body, right? This is the open. That is what? The bottom of the body. This is the body. Let me circle this here. The body of the candlestick is this over here, right? So this is the body, right? This is the body of the candlestick. So this is the bottom, right? Here is the bottom, right? This line over here, right? This line over here. Maybe I messed it up. Let me do it again, so at least I can get a good straight line. All right. Okay. All right. So this is the body. This is the bottom of the line over here, right? Okay. The bottom of the body. That's where it opens, right? And then the close is the top of the body, right? Let me use a different color, maybe yellow, right? Okay, all right. So this is a close, that is the top of the body, right? This is a close, right? And then the wick is the shadows, the line over here, that's a wick, right? A vertical line above and below, right? Above and below, over here. So that's where we derive, and we have the highs of that candle, and then the low of that candle as well. All right. Okay. All right. So that's where we have the highs and the low, right, of that candle. So an example is what we see over here. The open price is what? 50, right? That's the open price. Let me put an annotation over here, a quick annotation over here. That's the open. All right. I'm marking this with yellow. Maybe a good color will do. Let me see. Maybe you guys can see this. It's visible enough. All right. So the open price, the highest is what? 55 over here at the top, right? That's the highest, right? That is here, right? And then the low is 48, right? Here. That's what I'm talking about here, right? That's the low, right? 48. And then the close is what? 53, right? Right here. Okay. Hopefully you guys meet it. So what that means is what? It means the price started at 50, right? Buyers push it up as high as 55. Okay, sellers try to push it down to 48, but buyers step in again and it closed stronger at what, 53, right? So that is what that means over here, right? The anatomy of the candlesticks, right? The candlestick. If you take a look at it, that's what it means, right? So the candle body will be green, stretching from 50 to 53. The wick will extend to 55 at the top and 48 at the bottom, telling us this story, telling us and explaining, interpreting what has happened on the market with this candlestick over here. All right. Let's look at the red as well. All right. Let's take a look at the red candle. And I'm going to end it today over here on the red candle, right? At least we've started with this, and then we'll kick off from here next week. But the red candle, what does it mean, right? Sellers, that is bears, right, were stronger. When we take a look at the red candle, it also tells a story, right? Price closed lower than it opened. See, this is the opposite of the green one, right? If you take a look at the green candle and the red candle, they are different. They're different interpretations, but they're the same thing. But where it opened, where it closed is different. So on the red candle, the opening is at the top of the body, and then the close is at the what? The bottom of the what? The body. As you guys can see, that's the opposite of what we did on the green candlestick, right? So here, price close what? Lower than it opened. Look at the structure. Let's look at the structure of the candlestick. Is it the open, the top of the body, right? Let me get a quick pen over here to do annotation on the chart so you guys can understand it. Let me pick up a good color. Maybe red would do. All right. So it opened over here at the price of 60, right? So this way it opened, top of the body, right? The body of the candle. And then the close is what? The bottom of the body over here, right? Here. The bottom over here, right? That's why you see 55 over here. And then the wick, of course, we see the shadows show the strong, the highest and the lowest price during that time frame, right? And I told you guys, it doesn't matter whether it's 15 minutes, when the candlesticks are formed on different time frame, and every time frame kind of form the same thing, same translation goes into this, right? Same translation. It doesn't change anything, right? Doesn't change anything. Let's look at this, right? Doesn't change anything. So the highest and then the lowest over here. So price opened at 60. The highest of the day was what? 52, right? The highest of the day was 62. And then the lowest was what? 54. You guys can see that over here. That's the lowest, right? Well, my pen is misbehaving. All right, hopefully. All right. So here is the lowest. And then here is the highest, right? And then the open and close, you guys can see that as well, right? So it is an example, classic example of what we're talking about here. So the open is $60, the high is 62, the low is 54, close at 55, right? This means what? Price started at what? 60. Sellers push it down as low as what? Sellers, their goal is to push the price down, right? So they push it down as low as 54, right? It's trying to push it down. And when it's pushing more down, it's going downwards. That's how they make money, right? We short the market. When we short the market, we want the market to go down. We want the price to go down, right? Buyers try to push it up back again at 62, right? That is buyers. They're trying to push it up. No. It's a wrestle, like I said, right? It's a wrestle. They're trying to push it up. 62, that's buyers. And sellers step in again, and then they close it down at 55, right? You close it down. So the opening of the price, the close, the high, the low, something that you guys have to take note of. Whether it's a green candle, whether it's a red candle. So the candle body will be red, stretching from 60 to 55, right? The wick will extend to 62 at the top and 54 at the bottom, right? Okay, guys, this is where we're going to end tonight's session. I'm going to open the floor now. So you guys will be able to unmute yourself and then ask questions, and then we call it a day, call it a night, call it whatever that is in your time zone, right? We're going to call it whatever that is in your time zone, all right? So I'm just going to give 5 minutes, only 5 minutes. I know it's late. I'm going to give 5 minutes over here. I'm going to ask you guys to unmute. So you guys are free to unmute yourself now so you can speak, right? This class is an interactive session, interactive class, right? So you guys are free to speak, to talk. I want you guys to
All right. I have a quick question.
Yeah, go ahead. Who is speaking by
So
the way?
is the say that again?
Who is speaking by the way? I'm not looking at who is speaking or whatever. So just mention your name quick, you know.
This is Isaac.
Okay, all right, go ahead.
Is the understanding of the candle gives you the idea of when to enter or when to stop?
Right. So your question is, is when you understand where price open, close, etc. Is that an indicator for you to enter into a trade? That's what you're saying, right? It's a yes and it's a no, but in this training, it's a no. We don't trade with candlesticks opening and closing and all of that, right? No. But answer the question. No. All right. Anybody else? You will not get into a trade because the price closes. You say, no, let me go ahead and enter into a trade now. We're not doing that over here. You will not go ahead and enter into a sell because the price closes here and it does here and you see the candle, red candle over here, you see the green candle. No, we are not doing that over here, right? What we'll be doing is more powerful than that. What's going to go into our analysis is going to be more powerful than that. All right. Next person. I see a hand up. Juliet, go ahead. You have to unmute yourself. Go ahead. You need to unmute yourself. I see that. Yes, go ahead now.
Yes, please. Thank you very much. So I'm Juliet. Please, with regards to the candlestick, I want to use the green candlestick like, for example. Could that be an instance where the closing period, or let me say the closing amount, is the same as the high? And if that is a scenario like that is possible, what does it look like?
Yeah, so we'll be going through the different type. There are so many different type of candlesticks, right? So many of them. The bullish engulfing, doji, etc. Sometimes you open and close at the same place, right? Doji candle, etc. We'll be looking at all the different types of candlesticks that are out there. This is a whole session, right? Next week, Saturday morning, that we'll go deep dive into the candlesticks proper. This is just the opening of it. And so sometimes you see it open and close at the same place for the same time period. It could be a 15 minutes time frame, 1 hour time frame, 2 hour time frame, whatever. We open and close at the same place. But that is just to tell us that who is in control of the market. There's a lot of indecision on the market, right? If the market doesn't know which direction to go, whether to go up or to come down, or buyers and sellers are equal. When it opens and closes at the same place, then that means there's consolidation in there. There's what we call distribution and accumulation going on in there. That means buyers and sellers are equal. So that's why we are not able to determine which side is going, right? Because sellers and buyers are equal. They are breaking it even, right? There's levels like a break even. They are equal. They are just accumulating and distributing among themselves, right? So there is nobody overpowering or overwhelming the other party, right? So that's what happened. Whenever you see an explosive rally, a big candle, and then that means somebody's in charge. Somebody's in charge of the market, right? But we'll be going to all these different types of the candlesticks. That's a good question. Next week when we meet.
Yes, please. Thank you very much.
All right, you're welcome. Next person.
Hey, this is Prince speaking here. I just had a quick question.
Uh-huh.
I heard you mention that when it comes to trading, you also follow like the news trends and whatnot just to have a better understanding of where the market could be going. Could you, by any chance, like share or give any insights of what websites you go for those news updates?
Yeah, so we'll come to that. There are about 4-5 websites that we go to. We have Forest Factory. We have the Conor Day. Let me see if I can open some of them. There are so many of them. Where every morning, and I'll be teaching you guys. I don't have time for to go to all this website today, but I'm teaching you guys. Where every morning you go over there, you look at the economic calendar, you see the news that are coming ahead, so you already know that Trump will be speaking. the federal chairman will be speaking. You'll know that, you know, in Canada, there's PMI news, there's interest rate news coming in Canada. You know that, you know, in Britain, in United Kingdom, there is a PMI news, employment news, whatever coming. And if you are trading, let's say GBP USD, you know, the Great Britain pound USD, you should know that such news is going to impact on your trade. And so, you know, there's a lot of websites to see all these economic activities. And these calendars, they've done so well by even using color code. So when you see a red, you know, color code in there, then you should know that this is a high impact news. And that can be dangerous. If you're in a position, that can take you out. You know, if you see a red and if you're already in a position, you are trading, and there's a high impact news coming, that should tell you that it's either you back up from the trade or you stay in, but you have to be very careful because such high impact news at that time that you have specified that news will be coming out, maybe 8:30 a.m., 9:30 a.m., 10 o'clock a.m. That means that can trigger a reaction on the market, right? And so you have to be careful. That's what that means. Yeah, but we'll go to all these, you know, different places where you have to go and get your news and understand what is coming up for the day. Yeah, good. Yeah, that's a good question.
Thank you.
Yeah. Anybody else? I have just a few minutes. I want you guys to speak. If you want to say something, go ahead and unmute yourself, and then, you know, say it quick, and then we'll be done for the day. Anybody else? I'm gonna give ahead maybe some. I know we've already, and you know, thank you for staying as well. I know we've already exceeded by 15 minutes already, but yes, you know, you know, this is for you guys. This is for you guys. So, hey, for me,
One last question,
yeah.
sir.
Mhm.
All right. So, do you have any train model that we can use for the set?
So we'll come to that. You know, we'll come to that. Where you're going to do your set, you're going to have your entry price, you know, your target, etc. We'll come to that proper. That is where it's going to be our meat and potato. That's where we make money. That's where we're going to put in our trade, right? Where we will start price, our start price, exit price, you know, and I'll take profit, etc. That is going to be our bread and butter. Yeah. So we'll come to that. All right. Anybody else? Guys, I'm here for you. I'm here to answer all your questions, right? So, you know, don't be shy to say something, to add something. This is for you, right? It's for you guys. All right. I'm not doing it for myself. This is for you guys, right? This is why you pay money, you know, to be in this class. So ask question, you know. All right. I think that's it for the day. All right. So that's it for the day. Again, take note of the times that we have. Saturday morning, Sunday afternoon. So Saturday morning, 6 a.m. EST. That will be 5 a.m. CST. And that will be what in GMT? Because I know I have one or two people in London and some few people also in GMT Ghana time as well joining. And then some other people in different time zones also join. So just to take note of the time. And then Sundays to 4 p.m. 4 p.m. translating to 3 p.m. Central Standard Time, and then about 8 p.m. GMT as well, and whatever time that translates into United Kingdom time as well, for those of you that are also connecting from there. All right. So take note of the times very well. And then last announcement, of course, let me say this. I know some of you are just joining maybe the first 3 sessions or whatever, you know, for free. If you're in the WhatsApp group, that means you've paid. That means, you know, you are here with us. But hey, you know, like I said, the first 1, 2, 3, 4 something sessions is going to be for free. And beyond that, if you are entering into the Zoom or whatever, it's going to be for only my paid, you know, students, right? So be sure that, you know, if you like what you're seeing, whatever, make sure that, you know, you get in touch, and then make sure that you have your payment in there. But of course, you know, first session yesterday, second session today, next week's first, third session, etc. It's going to be, you know, for free for everybody, for the general public. I put it everywhere, different WhatsApp groups all over the world, right? So if you are joining and, you know, you like what you see, whatever, you can go ahead and, you know, reach out, and then, you know, get in touch. I know the notice or wherever you saw it from, there's a number in there, there's a phone number in there, that's there that you can, you know, reach out. All right. Okay. With that said, guys, have a great week. I'm going to be live around 10 p.m. You know, because I do market analysis for the week. And so if you are not, okay, somebody even said it. Let me go ahead and put this in the chat. If you're not what part of a WhatsApp group, you need to be part of it. Let me share the WhatsApp group so that because when we go live on YouTube and we go live tonight, etc., review the market, etc. Guys, this is a good place, for some of you, even though it's beginning for you. Come in and listen, right? Just tune in and listen to all the analysis that I'm doing for the rest of the week for some currencies, etc. For the past 2 weeks, etc. We've had big time trades and good money profit coming in, Euro USD, etc. I keep hitting all the time, right? All the trades that I put in, I analyze and say, hey, your entry price, your exit price. This is a good place for you guys to understand even the set, right? Your entry price, exit price, target, etc. I do all this analysis, in the video. So make sure that let me share the WhatsApp link in the chat, so that if you're not part of it, then you're gonna be missing out a lot. You got to be part. Let me share the WhatsApp link here, so that you join. Let me share it here on Zoom. Make sure that you tap on it and then you join. Oh, why is it picking up all this message right here? Let me. Okay, let's see. Let me do this and share this here.